In recent times, global financial markets have witnessed a notable increase in the cost of money, primarily reflected in rising interest rates. This phenomenon has far-reaching implications for businesses, consumers, and governments alike. Stay tuned till the end of the video to comprehend the reasons behind this surge in the cost of money. The phrase "cost of money is rising" generally refers to an increase in the overall cost associated with borrowing money or obtaining credit. This increase is typically reflected in higher interest rates, which affects various financial instruments and transactions. The cost of money is a crucial factor in economic decision-making for individuals, businesses, and governments. One of the significant drivers behind the rise in the cost of money is the shift in central bank policies. Central banks, such as the Federal Reserve in the United States, have been adjusting their monetary policies to address evolving economic conditions. In response to factors like inflationary pressures or economic overheating, central banks may raise interest rates to cool down the economy and maintain stability. Central banks utilize interest rates to achieve various economic objectives, such as controlling inflation, supporting economic growth, and maintaining employment. When a central bank believes that inflation is rising above the target or the economy is at risk of overheating, it may choose to raise interest rates. Central banks typically have an inflation target, which is the desired level of inflation considered conducive to economic stability. By adjusting interest rates, central banks aim to influence spending and investment patterns in the economy. Raising interest rates makes borrowing more expensive, leading to reduced spending and investment, which can help control inflation. Central banks are also concerned about the formation of asset bubbles, such as in the housing or stock markets, which can lead to financial instability. To prevent excessive risk-taking and speculation, central banks may raise interest rates to make borrowing for investments more expensive, thereby cooling down asset markets. Changes in interest rates can influence currency values. Higher interest rates can attract foreign capital seeking better returns, leading to an appreciation of the domestic currency. This can have implications for trade balances and export competitiveness. Central banks may adjust interest rates to achieve a balance in exchange rates and support the overall economic outlook. Central banks often provide forward guidance to signal their future policy intentions. The mere announcement of potential future rate hikes or cuts can influence current market expectations and impact interest rates. Clear communication from central banks helps guide market participants in their decision-making process. In an interconnected global economy, central banks may coordinate their policies to address common challenges. For example, during a period of global economic downturn, central banks might collectively lower interest rates to stimulate economic activity. Conversely, in times of potential inflationary pressures, central banks might coordinate to tighten monetary policy. Next is definitely inflation. Inflation, the general increase in price of goods and services, plays a pivotal role in influencing interest rates. As central banks aim to control inflation within a target range, a surge in inflationary pressures can prompt them to raise interest rates. Higher interest rates help curb excessive spending, which in turn can contribute to easy inflationary pressures. When an economy is thriving and experiencing robust growth, the demand for money tends to rise. This heightened demand can lead to an increase in interest rates. Central banks may choose to raise rates to prevent the economy from overheating and to maintain a balance between growth and stability. Higher interest rates act as a brake on spending and investment, making borrowing more expensive. This in turn contributes to an increase in the overall cost of money in the economy. Economic growth often leads to job creation, reducing unemployment rates. As employment levels rise, consumer spending tends to increase, further stimulating economic growth. Additionally, low unemployment rates can also influence central banks to tighten monetary policy, contributing to higher interest rates. Higher interest rates can influence the decision-making process of businesses regarding capital investment. When the cost of borrowing is high, companies may scale back on capital projects and expansion plans. Reduced business investment can have a cascading effect on economic activity, leading to slower growth. As the cost of capital rises, businesses may find it less attractive to borrow for expansion or innovation projects. Higher interest rates not only affect businesses but also impact consumers. Increased interest rates lead to higher costs for mortgages, car loans, and credit cards. As the cost of servicing debt rises, consumers may cut back on discretionary spending, affecting overall economic activity. Central banks also consider real interest rates, which are adjusted for inflation. Even if nominal interest rates rise, the real interest rate or nominal rate minus inflation may still be low. providing a nuanced view of the actual cost of borrowing. Global economic factors can significantly impact the cost of money. For example, geopolitical events, trade tensions, or economic slowdowns in major economies can create uncertainty and influence interest rates. Central banks may respond to these global developments by adjusting their monetary policies, contributing to changes in the cost of money. In today's globalized world, economic conditions in one part of the world can have ripple effects across borders. Changes in major economies, geopolitical events, or trade tensions can create uncertainty and impact financial markets globally. Expectations and sentiment in financial markets can have a profound impact on interest rates. If investors anticipate future inflation or economic challenges, they may adjust their investment strategies accordingly, leading to increased demand for higher interest rates. Market sentiment can create a self-fulfilling prophecy where expectations drive actual market outcomes. During periods of global economic uncertainty, investors may seek safe haven assets such as government bonds, causing an increase in demand for these securities. The increased demand can lead to higher bond prices and lower yields. Since bond yields move inversely to bond prices, this can effectively raise the cost of borrowing for governments and corporations. Market participants often form expectations about future economic conditions based on a variety of factors, including economic data, geopolitical developments, and central bank communication. Central banks and policymakers provide guidance on their future policy intentions. If investors anticipate that interest rates will rise in the future, they may adjust their investment strategies accordingly, leading to changes in market interest rates. Bond yields, which represent the return on fixed income investments, are influenced by market expectations. If investors expect higher inflation or interest rates, they may demand higher yields to compensate for the perceived increase in risk. As bond yields rise, the cost of borrowing for governments and corporations increases. Investor sentiment plays a crucial role in financial markets. When investors are optimistic and have a higher risk appetite, they may be more willing to invest in riskier assets, leading to lower demand for safe haven assets like government bonds. Conversely, during periods of heightened uncertainty or pessimism, investors may demand higher returns to compensate for increased risk. This results in higher risk premiums, contributing to higher interest rates and the overall cost of money. Investor sentiment can influence currency exchange rates. If investors are optimistic about a country's economic prospects, they may flock to that country's currency, leading to appreciation. A stronger currency can lower inflationary pressures by making imported goods cheaper. In response, central banks may raise interest rates to prevent deflation and maintain price stability, contributing to the rise in the cost of money. Market sentiment can drive speculative behavior and contribute to the formation of asset bubbles. Central banks may raise interest rates to cool down speculative excesses, especially in housing or equity markets, to prevent financial instability. The anticipation of a market correction can lead to changes in investor behavior with a potential shift towards safer, interest-bearing assets. This increased demand for safe haven assets can raise their prices, lowering yields and pushing up the cost of money. Policymakers and market participants closely monitor these dynamics to anticipate and respond to changes in the economic environment. The rising cost of money is a complex interplay of various economic factors, including central bank policies, inflationary pressures, economic growth, global conditions, and market sentiment. Understanding these dynamics is essential for businesses, investors, and policymakers to navigate the evolving financial landscape. The rising cost of money, marked by increasing interest rates, significantly affects individuals across various aspects of their financial lives. For consumers, higher interest rates translate into increased borrowing costs, as mentioned before, making mortgages, car loans, and credit card debts more expensive to service. This in turn constrains disposable income and may lead to reduced spending on goods and services. Savers, on the other hand, may benefit from higher interest rates as they receive better returns on savings accounts, certificates of deposit, and other fixed income investments. However, the overall impact on individuals depends on their financial positions, with borrowers facing greater challenges while savers may experience improved returns. Additionally, rising interest rates can influence the broader economy, affecting job markets, investment opportunities, and the overall cost of living, thus shaping the financial landscape for individuals in various ways. In summary, when we say the cost of money is rising, we are referring to an environment in which interest rates are increasing. This has wide-ranging effects on the economy, influencing borrowing costs, investment decisions, financial markets, and overall economic activity. As interest rates continue to be a critical determinant of economic activity, staying informed about the factors driving their fluctuations is crucial for making informed financial decisions. Hope you liked watching our video. If you enjoyed watching this video, then click on like and definitely subscribe to our channel. Share your ideas and views in the comment section below.